When most people think about currency collapse, they imagine chaos erupting overnight. Grocery shelves emptying, ATMs going dark, and life savings becoming worthless by morning. But that's not how currencies die. They follow a predictable 7-stage pattern that has played out repeatedly throughout history. And right now, the US dollar is deep into stage 5. The euro, the ruble, the franc, and dozens of other currencies have traveled this same road. Some completed the journey to total collapse. Others caught themselves at the brink and implemented desperate measures to reverse course. But here's what the central banks and government officials won't tell you. Once a currency reaches stage 5, there are only 2 possible outcomes. Either you experience a crisis so severe it forces painful reforms, or you continue down the path to complete monetary destruction. Understanding these 7 stages isn't academic theory. It's the difference between preserving your wealth and watching it evaporate. Because while currencies collapse in predictable patterns, most people don't recognize the warning signs until it's far too late to protect themselves. The good news is that each stage offers specific opportunities for those who know what to look for. The bad news is that we're running out of time. The pattern was first documented during the collapse of Weimar Germany, when the Papier mark went from 4.2 to the dollar in 1914 to 4.2 trillion to the dollar by 1923. But the same 7 stages appeared during the Argentine peso crisis, the Zimbabwean dollar collapse, and more recently in Venezuela and Turkey. The mechanics changed slightly based on each country's specific circumstances, but the underlying progression remains remarkably consistent. Stage 1 begins with fiscal irresponsibility. Governments spend beyond their means, running deficits that seem manageable in the short term but compound into mathematical impossibilities over time. The public doesn't notice because economic growth masks the underlying problems. Tax revenues are rising, employment is strong, and politicians can point to prosperity as evidence that their policies are working. But beneath the surface, debt is accumulating faster than the economy's ability to service it. The United States passed through stage 1 decades ago. Federal debt has grown from roughly 30% of GDP in 1982 over 120% today. But because the dollar serves as the world's reserve currency, the consequences that would have destroyed other nations were postponed. The ability to print the currency that the entire world needs for trade created a unique situation where normal rules didn't seem to apply. This advantage allowed the US to progress through the early stages more slowly than other countries. But it doesn't change the final destination. Stage 2 involves monetary expansion to finance the growing deficits. When tax revenues prove insufficient to cover spending, central banks begin creating new currency to bridge the gap. Initially, this expansion seems harmless. Inflation remains subdued, interest rates stay low, and asset prices rise in ways that make everyone feel wealthier. The Federal Reserve's balance sheet expansion from less than $1 trillion before 2008 to over $8 trillion today represents a textbook example of stage 2 in action. Other currencies reach this stage through different mechanisms, but with similar results. The European Central Bank pushed interest rates negative and purchased trillions in government bonds. The Bank of Japan became so aggressive that it now owns a substantial portion of all Japanese government debt. The Russian central bank printed rubles to support favored industries and maintain employment during sanctions. Each approach had local variations, but all involved creating currency faster than underlying economic growth justified. Stage 3 introduces the first visible signs of trouble. Asset bubbles form as the newly created currency seeks returns in a low-interest environment. Stock markets reach valuations that can't be justified by underlying earnings. Real estate prices surge beyond what average workers can afford. Speculation replaces investment as the primary driver of economic activity. The wealth gap widens dramatically as asset owners benefit from inflation while wage earners fall behind. We're watching this play out in real time across developed economies. Homes in major cities cost 10 to 20 times the median annual income, making ownership impossible for entire generations. Stock market valuations have reached levels seen only twice before in history, both times immediately preceding major crashes. Cryptocurrency speculation reached such extremes that digital tokens with no underlying value traded for billions of dollars. These aren't signs of prosperity, but symptoms of a currency system that's lost touch with reality. Stage 4 brings the awakening. Inflation that was dismissed as transitory becomes persistent and problematic. Central banks face an impossible choice: continue printing currency and accept accelerating inflation, or stop printing and trigger the collapse of asset bubbles built on cheap credit. Either path leads to stage 5, but the route taken determines who suffers most from the transition. The bond market begins signaling distress as long-term interest rates rise despite central bank efforts to suppress them. Currency relationships start shifting as international investors recognize the problem. Capital flows reverse as smart money seeks safer havens. Countries that seemed economically strong begin showing cracks in their foundations. Trade imbalances that were ignored during good times become unsustainable. The mathematical reality that was postponed through monetary manipulation finally demands acknowledgement. This is where most currencies either implement emergency reforms or continue toward complete collapse. Stage 5 is where the dollar finds itself now, and it's the most dangerous phase in the currency collapse pattern. At this stage, central banks have lost control of the narrative, but haven't yet lost control of the currency itself. Inflation is running well above target levels, despite official assurances that it's under control. Interest rates are rising, but remain artificially suppressed relative to true inflation rates. The gap between official economic statistics and lived reality grows wider every month. The signs are unmistakable for those willing to see them. Real wages adjusted for actual inflation have been declining for years, yet employment statistics suggest a strong labor market. Housing affordability has reached its worst levels in modern history, yet real estate is promoted as a solid investment. Food and energy costs are consuming larger portions of household budgets, yet core inflation measurements exclude these items to present a more favorable picture. The disconnect between official numbers and actual conditions is a hallmark of stage 5. Central bank credibility erodes during this phase as their predictions repeatedly prove wrong. The Federal Reserve insisted inflation was transitory even as prices surged month after month. Interest rate guidance changed constantly as economic conditions refused to follow the predicted path. Forward guidance that markets once relied upon became meaningless as policy shifted reactively rather than proactively. When central banks lose credibility, they lose the ability to manage expectations. And that's when things accelerate towards stage 6. The treasury market, which serves as the foundation of global finance, is showing stress fractures that would have been unthinkable a decade ago. Liquidity has deteriorated to levels typically seen only during crisis periods. Volatility has increased dramatically as traditional buyers step back from the market. Foreign central banks that once purchased treasury bonds automatically are now net sellers, forcing the Federal Reserve to fill the gap. This dynamic creates a dangerous feedback loop where the central bank must print currency to buy the government debt that funds the deficits that require more currency creation. Corporate debt markets reflect similar stress. Companies that should have failed years ago remain operational only because credit is still available at rates that don't reflect true risk. Zombie corporations that generate insufficient cash flow to service their debt survive by rolling over loans in a market that hasn't yet recognized their insolvency. When interest rates rise or credit conditions tighten, these zombies will collapse simultaneously, triggering the cascade that marks the transition to stage 6. Consumer finances show the strain of stage 5 conditions. Credit card debt has reached record levels as households borrow to maintain living standards that their wages no longer support. Auto loan terms have stretched to 7 or 8 years, turning depreciating assets into long-term financial obligations. Student debt continues accumulating despite mounting evidence that the promised returns aren't materializing. Savings rates have collapsed as current consumption takes priority over future security. These conditions aren't sustainable, but they persist as long as credit remains available. The international dimension adds complexity that didn't exist in previous currency collapses. The dollar's role as reserve currency means its problems affect the entire global financial system. Countries holding dollar reserves watch their purchasing power erode but have limited alternatives. The euro faces its own stage 5 challenges with negative interest rates and growing debt tensions among member states. The yen is even further along the collapse pattern, with the Bank of Japan trapped in perpetual monetary expansion. The yuan remains controlled but faces demographic and debt challenges that may prove insurmountable. This creates a race to the bottom where every major currency is devaluing against real assets but maintaining relative stability against each other. Gold and silver prices reflect this dynamic, rising gradually in all major currencies but not experiencing the explosive moves that would indicate complete loss of confidence in any single currency. Real estate in prime locations appreciates in all currencies simultaneously, not because properties are becoming more valuable, but because the currencies are becoming less valuable. Productive businesses see their nominal values rise even as their real profitability stagnates or declines. The political response to Stage 5 conditions follows a predictable pattern. Officials blame external factors rather than acknowledging the mathematical inevitability of their policies. Scapegoats are identified to deflect attention from monetary mismanagement. Corporate greed, foreign manipulation, or supply chain disruptions get cited as causes of inflation when these are symptoms rather than sources of the problem. Price controls and regulatory restrictions get implemented despite centuries of evidence that such measures worsen shortages while failing to address underlying causes. Wealth inequality accelerates during Stage 5 because the wealthy own assets that appreciate with currency debasement, while the poor and middle class hold currency, and fixed income investments that lose purchasing power. This creates political instability that adds to economic uncertainty. Populist movements gain strength by promising solutions that sound appealing, but would accelerate the currency's collapse if implemented. The social fabric begins fraying as different groups compete for resources from a system that can no longer deliver on its promises to everyone. Stage 6 begins when loss of confidence becomes self-reinforcing. To this point, inflation isn't just an economic problem, but a psychological one. People start changing behavior in ways that accelerate currency debate. Workers demand inflation adjustments, knowing that fixed wages mean real pay cuts. Businesses raise prices preemptively rather than waiting for cost increases to justify the moves. Consumers stockpile goods expecting higher prices tomorrow. Foreign investors reduce dollar exposure not because of current conditions, but because they anticipate worse conditions ahead. The velocity of money increases dramatically during Stage 6. Currency that was saved or invested during earlier stages gets spent rapidly, as people try to convert it into real goods before it loses more value. This surge in spending appears as economic growth in official statistics, creating the illusion of prosperity even as the currency's purchasing power accelerates its decline. Import prices spike as foreign suppliers demand more currency for the same goods. Export competitiveness improves temporarily but fails to offset the damage from imported inflation. Central banks face their moment of truth during Stage 6. They can raise interest rates aggressively to defend the currency's value, accepting the recession and asset price crashes that result from such action. Or they can continue accommodating inflation, accepting accelerating currency debasement to avoid immediate economic pain. History shows that most central banks choose the path of least immediate resistance, continuing to print currency until forced into emergency action by complete loss of confidence. The bond market typically breaks during Stage 6. Long-term interest rates spike as investors refuse to hold fixed income securities that guarantee real losses. Government borrowing costs surge at exactly the moment when deficits are widest and financing needs are greatest. The currency experiences sharp devaluation episodes rather than the gradual decline of earlier stages. Capital controls get implemented to prevent flight, but this only confirms investors' fears and accelerates the exodus. Black markets emerge as official exchange rates diverge from reality. Argentina's provided multiple examples of Stage 6 dynamics over the past several decades. Each crisis followed the same pattern: fiscal irresponsibility, monetary expansion, asset bubbles, persistent inflation, loss of confidence, and then the crisis that forced emergency measures. The peso lost over 99% of its value against the dollar across multiple devaluation episodes. Citizens learned to convert currency to dollars or goods immediately upon receiving it. The middle class was effectively destroyed as savings became worthless. Only those who understood the pattern and positioned accordingly preserved their wealth. Turkey more recently demonstrated Stage 6 characteristics. The lira lost over 80% of its value in just a few years as the central bank kept interest rates artificially low despite surging inflation. Citizens rushed to convert lira to dollars, gold, or foreign assets. Import prices skyrocketed, creating shortages of essential goods. Tourism boomed temporarily as the currency's weakness made the country cheap for foreign visitors. But this couldn't offset the damage to domestic purchasing power. President Erdogan's insistence that high interest rates cause inflation rather than cure it accelerated the currency's decline. The Russian ruble experienced rapid Stage 6 progression following the invasion of Ukraine and resulting sanctions. The currency lost half its value in weeks before stabilizing through aggressive capital controls and forced conversion of export revenues. But the underlying problems remain. Isolation from Western financial markets limits Russia's options. Energy export revenues that once seemed permanent are threatened by European diversification efforts. Military spending consumes resources that might otherwise support the economy. The ruble's apparent stability masks deeper structural issues that will resurface as the war's costs mount. Venezuela represents the most complete recent example of progression through all 7 stages. The believer went from stage 1 fiscal irresponsibility under Chavez through stages 2 to 5 during the commodity boom years. Stage 6 arrived when oil prices collapsed and socialist policies destroyed productive capacity. Stage 7. Hyperinflation resulted in currency redenominations that lopped off zeros while doing nothing to address underlying problems. Citizens abandoned the bolivar entirely for dollars and crypto. The government lost the ability to collect taxes or provide services. What was once Latin America's wealthiest nation became an economic wasteland. Stage 7 represents complete currency collapse and the end of the monetary system as previously structured. Hyperinflation makes the currency worthless for transactions. Barter systems emerge as people trade goods directly rather than using currency as an intermediary. Foreign currencies become the de facto medium of exchange. The government either implements a complete monetary reset with a new currency or surrenders monetary sovereignty entirely by adopting a foreign currency. Either way, the old currency's holders lose essentially everything they held in cash or fixed income securities. The Weimar Republic remains the canonical example of Stage 7 collapse. The Papier mark went from modest inflation during World War I through all 7 stages in less than a decade. By 1923, workers are paid multiple times per day and spent their wages immediately because prices doubled within hours. Wheelbarrows full of currency were required to buy basic goods. Lifetime savings became worthless. The social and political consequences included the rise of extremism that ultimately led to World War II. The lesson is clear. Currency collapse doesn't just destroy wealth. It can destroy entire civilizations. Zimbabwe's dollar collapse in the 2000s followed a similar path but in compressed time frame. The government's seizure of commercial farms destroyed agricultural production and export earnings. Monetary expansion to finance military operations and maintain political support created inflation that accelerated through all 7 stages in just a few years. By 2008, inflation reached rates that made daily life impossible. The government eventually abandoned the Zimbabwe dollar entirely and adopted a basket of foreign currency. Citizens lost all value held in the local currency. The dollar's role as global reserve currency creates a unique situation that has allowed progression through the stages to occur more slowly than with other currencies. Roughly 60% of global foreign exchange reserves are held in dollars. International trade is primarily conducted in dollars, even when neither trading partner is the United States. Commodities from oil to gold are priced in dollars. This creates structural demand that supports the currency's value regardless of underlying economic conditions. This reserve status has given the United States an extraordinary privilege. The country can run persistent trade and budget deficits that would destroy other nations. Currencies, because the world needs dollars for trade and reserves. Foreign central banks are forced to accumulate treasury bonds to manage their exchange rates and facilitate international commerce. This captive demand has allowed the Federal Reserve to expand the money supply on a scale that would have collapsed other currencies decades ago. But reserve status isn't permanent, and the advantages it provides are eroding. The euro was created partially to challenge dollar dominance, but has failed to provide a credible alternative due to structural weaknesses in the European Union. The yuan is gradually increasing its role in international trade, but remains limited by capital controls and lack of full conversion. Digital currencies and blockchain technology may eventually provide alternatives that don't depend on any single nation's monetary policy. The dollar's decline from 70% of global reserves 2 decades ago to 60% today seems minor, but the trajectory is clear. The BRICS nations, Brazil, Russia, India, China, South Africa have openly discussed creating alternative payment systems and reserve currencies. While no credible replacement exists today, work toward that goal continues. Saudi Arabia has entertained offers to price oil in currencies other than dollars, which would undermine a key pillar of dollar demand. China has established bilateral currency swap agreements with dozens of countries to facilitate trade without dollars. These developments are gradual but cumulative, chipping away at the structural advantages that have protected the dollar. The weaponization of the dollar through sanctions has accelerated the search for alternatives. When the US froze Russian central bank reserves in response to the Ukraine invasion, it demonstrated that dollar holdings aren't truly safe from political seizure. Other nations watched and drew conclusions about the risks of depending too heavily on dollars. The more the US uses the financial system as a political weapon, the more urgently other nations seek alternatives. This is a self-inflicted wound that may prove more damaging than any external challenge. Technology is creating options that didn't exist in previous currency. Cryptocurrencies allow individuals to hold assets outside any nation's control. Stablecoins provide dollar exposure without requiring traditional banking relationships. Central bank digital currencies may allow international trade without correspondent banking networks. Distributed ledger technology could enable settlements that bypass the dollar entirely. While these technologies face regulatory challenges and adoption barriers, they represent potential pathways around dollar dominance that didn't exist for previous reserve currencies. But here's the critical point. Even if the dollar maintains its reserve status, that doesn't prevent progression through the 7 stages. Reserve status slows the process and changes some dynamics, but it doesn't alter the fundamental mathematics. A currency that's created faster than the underlying economy grows will eventually lose purchasing power regardless of how many foreign central banks are forced to hold it. The question isn't whether the dollar will face the consequences of stage 5, but when those consequences become unavoidable and how severe they'll be when they arrive. The federal debt trajectory makes stage 6 progression almost inevitable without dramatic policy changes, even with optimistic economic growth assumptions. Interest payments on the debt will consume an increasingly large portion of the budget. The Congressional Budget Office projects debt reaching 180% of GDP by 2050 under current policies. But that assumes no major recessions or crises requiring additional spending. In reality, the debt will likely grow faster as aging demographics, strained entitlement programs, and geopolitical tensions require increased military spending. Social Security and Medicare face funding shortfalls that will require either benefit cuts, tax increases, or currency creation to bridge the gap. Politically, benefit cuts and tax increases are nearly impossible to implement on the scale required. That leaves monetary expansion as the path of least resistance. The Federal Reserve will be pressured to purchase treasury bonds to keep interest rates manageable and the government operational. This is how stage 5 transitions to stage 6 in reserve currencies. Not through dramatic crisis, but through gradual acceptance that the central bank exists primarily to finance government operations. The defense of dollar reserve status may actually accelerate its decline through a paradox that few policymakers seem to recognize. Maintaining global military presence and enforcing the rules-based international order that supports dollar dominance requires spending that contributes to the debt problem driving currency debate. Backing away from that role might preserve fiscal sustainability, but would undermine the geopolitical conditions that support reserve status. Either path leads to erosion of the advantages that have protected the dollar, just through different mechanisms. Understanding which stage your currency is in matters less than understanding what comes next and how to position accordingly. For dollar holders, the reality is sobering. Stage 5 has historically been followed by either painful reforms that inflict severe but temporary economic damage, or progression to stages 6 and 7 that destroy the currency entirely. There's no comfortable middle path where everything works out fine without significant disruption. The reforms required to reverse course from stage 5 would include fiscal austerity that meaningfully reduces deficits, monetary tightening that accepts recession to stabilize the currency, and structural changes that address unsustainable entitlement programs. These measures would trigger immediate economic pain, including unemployment, asset price declines, and political turmoil. No major democracy has willingly implemented such reforms without being forced by immediate crises. The political incentives all favor postponing pain and hoping for miracle solutions that history shows don't exist. This means the most likely path is continued progression toward stage 6, which could arrive gradually over years or suddenly in response to a specific catalyst. The catalyst might be a debt crisis when foreign buyers step away from treasury auctions. It could be an inflation shock from supply disruptions or geopolitical events. It might result from loss of confidence following a recession that requires massive new currency creation. The specific trigger matters less than the underlying conditions that make the system vulnerable to any number of potential shocks. Positioning for this environment requires abandoning conventional financial wisdom and thinking in terms of currency destruction rather than portfolio optimization. Traditional advice about balanced portfolios with stocks and bonds fails when bonds guarantee real losses and stocks are valued based on currency that's losing purchasing power. The framework needs to shift from maximizing returns to preserving purchasing power and maintaining optionality as conditions evolve. Physical gold and silver become more attractive in stage 5 and essential in stage 6. These aren't investments in the traditional sense, but insurance against currency destruction. When Venezuela's bolivar became worthless, those who held gold maintained their wealth. When the Argentine peso collapsed repeatedly, gold holders preserved purchasing power When Weimar Germany's Papiermark failed, gold was the only form of savings that survived intact. The pattern repeats. Across every currency collapse in history, gold maintains value when fiat currencies fail. But precious metals alone aren't sufficient. They preserve wealth but don't generate income or provide participation in productive enterprise. A complete strategy requires exposure to real assets that maintain value regardless of currency fluctuation. This includes productive farmland, quality real estate in desirable locations, and ownership stakes in businesses with pricing power and real earnings. These assets may fluctuate in nominal value measured in dollars, but they maintain intrinsic value measured in what they produce or provide. International diversification becomes crucial but must be implemented thoughtfully. Simply holding foreign currencies doesn't help if those currencies are in similar or worse stages of collapse. The euro faces structural challenges that may prove insurmountable. The yen is beyond stage 5 and trapped in perpetual monetary expansion. The pound faces post-Brexit economic adjustment. Most emerging market currencies are too volatile and too dependent on dollar financing to provide safe harbor. The goal isn't finding a better currency, but spreading risk across multiple currencies while maintaining purchasing power in real assets. Energy and commodity exposure provides partial inflation protection, but requires careful timing. These assets tend to appreciate during the monetary expansion phases, but can collapse during the deflationary crisis that often accompanies. Stage 6. The key is avoiding permanent capital loss while maintaining exposure to the long-term trend of currency debasement. This might mean owning energy companies rather than commodities directly, or maintaining positions sized appropriately relative to other holdings. Cryptocurrency represents a new and uncertain element in currency collapse dynamics. Bitcoin and other decentralized digital assets could provide alternatives that bypass traditional monetary systems, but they remain untested in true crisis conditions and face regulatory risks that could limit their utility. A small allocation might make sense as an asymmetric bet, but these shouldn't form the core of a currency collapse strategy. They are too speculative and too dependent on continued technological infrastructure to serve as reliable stores of value. Geographic diversification goes beyond financial assets to include physical location and citizenship options. Individuals tied to a single jurisdiction face concentrated risk if that location experiences severe economic or political disruption. Having the ability to relocate, whether through second citizenship, residency permits, or simply maintaining flexibility in living arrangements, provides options that become valuable during crisis periods. This doesn't require abandoning your home country, but rather ensuring you're not trapped if conditions deteriorate severely. That becomes a complex strategic consideration in late-stage currency collapse. Inflation benefits borrowers by allowing repayment with devalued currency, but this advantage only materializes if you can maintain income and avoid forced liquidation during the crisis phase. Fixed-rate mortgage debt secured by real assets might be beneficial. Variable-rate debt or unsecured borrowing creates vulnerability. The key is ensuring debt serves strategic purposes rather than financing consumption that won't be sustainable if income disrupts. Skills and human capital become more important than paper assets during severe disruption. The ability to provide value through work, services, or expertise maintains worth regardless of currency conditions. Investing in education, skills, development, and relationship building provides returns that can't be inflated away. This is particularly important for younger people who may live through multiple currency crises over their lifetimes. Community and social networks provide resilience that isolated individuals lack. During Argentina's crisis, extended families pooled resources and supported each other through severe hardship. In Venezuela, community organizations facilitated barter and mutual assistance when the currency failed, building strong local relationships and participating in community. Organizations create social capital that becomes valuable when formal institutions fail to provide expected support. The psychological preparation may be most important of all. Watching your currency lose value while authorities insist everything is fine creates cognitive dissonance that can paralyze. Understanding the pattern and accepting its inevitability allows you to act decisively when others are paralyzed by uncertainty. This isn't pessimism, but realism, recognizing that stage 5 has historically led to stage 6 and positioning accordingly. The timing remains uncertain, which is why gradual positioning makes more sense than dramatic moves. Converting everything to gold today might prove premature if stage 5 persists for years. Waiting for certainty before acting guarantees you'll be too late. The optimal approach involves steady accumulation of real assets, reduction of currency exposure, and maintaining flexibility to accelerate or decelerate positioning as conditions evolve. We're living through the late stages of the dollar's dominance and the financial system built upon it. The seven-stage pattern of currency collapse that has played out repeatedly throughout history is once again approaching its culmination. Those who understand the pattern and position accordingly won't just preserve their wealth, they'll be positioned to acquire assets from those who failed to recognize the signs until it was too late. The greatest wealth transfers in history occur during currency collapses, moving assets from the unprepared to the prepared. The question isn't whether this transfer will happen, but which side of it you'll be on when it does.